I know right now a lot of us are talking about rising rates. Obviously, that's causing some issues for a lot of companies, at least here in the U.S. You're also watching the rates, the bond market, and you're saying, while a lot of people are going there for yield and maybe as a place to go for safety, you're actually concerned about the liquidity and the volatility of the bond market. Can you explain?
Well, absolutely. I mean, essentially, the bond market is the anchor pricing for virtually everything. And what you see signals of the bond market starting to get unhinged. You talk about liquidity. You know, we've all seen what happened last week. The liquidity levels in the bond markets were as low as they were in the peak of the pandemic. And that's when the Fed had to come in to rescue. You know, the other thing you're seeing, and obviously the QT from the Fed is a big driver of the illiquidity there. But another factor in the bond market that you see that is worrisome is an apparent sort of decoupling between what you're seeing in yield action and what you're seeing in the real economy. For example, ISMs retreating further and further, whilst yields still keep going up. For example, inflation expectations really starting to come down, whilst yields still keep going up. And if that's the reference points for all pricing, if that's the basis that market participants have been talking about items like TINA, that can indeed be a worrisome picture, Frank.
Yeah, there is no alternative other than stocks, or there's no alternative stocks, TINA. That trade's obviously broken down a bit. One other thing a lot of people have been talking about here on CNBC as well is that the 2-year with a 4% yield's more attractive, but you're also looking at company debt, and you're saying company debt's actually starting to compete with the equities of the companies themselves.
Absolutely. I mean, it's incredible. So this is a world we're simply not used to because it's been such a long time. It's almost 2008 levels of corporate debt yields. And we're talking about large cap, net cash balance sheet stocks, well, companies which are offering, 5-year yields north of 3%. You compare that to, for example, the dividend yield of the S&P. And, your point, there is no alternative, which became Trina. There really is no alternative. The new dialogue is RIP Tina or RIP Trina. Those maths just don't work anymore. And that's why equities have had such a tough time.
All right, one last thing before we let you go. We've been talking a lot about the strong dollar, trading in parity with the sterling and the euro and how it could impact U.S. company earnings. How's it impacting Eurozone company earnings in the near term? And what do you think that means for the long term?
Well, it's certainly very beneficial for the short term. So what you see, I mean, in general, earnings expectations have held up in a remarkably resilient way. You're starting to see downward earnings revisions in the U.S. equities space, which is not surprising at all. That's not happening within European equities simply because, as you say, Frank, the strong dollar has been helpful. But that is temporary in nature. And obviously, the year-on-year comparisons will only get tougher. So that's not something that one can fundamentally rely on longer term.